Want to be sure you are getting the most out of your retirement? For all the years of your retirement? That's the primary goal of More Living with Jim Brogan and our Dollars and Cents segment, where we provide you with an important financial tip that will help positively impact the quality of your life in retirement. And now, here's Jim with this week's Dollars and Cents tip.
Prices keep climbing. Wages are struggling to keep pace with inflation. The dollars you saved 5 years ago buy less and less with each passing month, and traditional retirement calculations suddenly look insufficient when you factor in persistent inflation over decades. Inflation doesn't just make things more expensive today. It changes how you should approach every financial decision, from retirement contributions to debt management and investment allocation. According to research, inflation is expected to remain elevated at 2.8% by the fourth quarter of this year, 2026, well above the Federal Reserve's 2% target. So understanding how persistent inflation affects your financial plan determines whether you maintain purchasing power in retirement or watch your wealth slowly erode despite earning and saving diligently. You know, the purchasing power erosion, the real cost of inflation, every percentage point of inflation reduces what your money can buy. So at a hypothetical 3% annual inflation, $100,000 of income today, in 5 years, that same $100,000 will purchase roughly $86,000. Okay, so that's a 14% reduction in income if you're drawing $100,000 in the same amount of income in 5 years as you are now. And over 10 years, it is a 74,000. So that's a 36% or 26% reduction. In other words, 100,000 10 years from now, 3% per year inflation is worth 74,000. So we look at things like, the returns on our portfolio. And what you make on your money, the most important measurement of determining how you're doing over time is how you're earning money relative to the inflation rate. You know, if inflation's 3%, we need to earn more on our money than if inflation was at 1.5% or 2%. Most people underestimate inflation's impact because they focused on nominal growth rather than real purchasing power. Your real purchasing power is if you make 6% and inflation is 3%, your real return is just 3%. And that can create fixed income vulnerability for retirees. You know, pensions, annuities, Social Security income payments typically don't keep up with cost of living adjustments. And if they don't, they lose value each year that inflation persists. So, Social Security includes annual adjustments, but these adjustments may not fully capture your true annual cost increases, especially in healthcare and housing, where inflation typically runs higher than the consumer price index. Then you have, you may have pensions that aren't adjusted for inflation. Now, pensions are becoming less and less likely for many retirees today. So I think what it means is number one, we have to look at increased savings requirements if we're in our savings years. Might need a bigger pot of money. Might need to be saving more money. Number two, we need to consider how much are we going to start withdrawing when we retire. And maybe the 4% rule where we draw 4% off our life savings, is that really safe? Now then finally, when it comes to your investment portfolio, stocks historically outpace inflation over long periods of time, making them essential for maintaining purchasing power. Cash and fixed income investments lose ground when inflation exceeds their yields, which remains common even in current markets despite higher interest rates than in recent years. The heavy reliance on bonds and cash for safety can inadvertently create inflation risks that over time are more dangerous than market volatility. That's right. Market volatility is something we see as a danger in the short term, and that absolutely needs to be managed in terms of our income planning. But in the long term, inflation risk can become much more dangerous when we overly rely on bonds. So I'm not saying don't have bonds in your portfolio, but be very, very careful with how you manage your equity exposure in a smart and systematic way.
That's our Dollars and Cents segment for this week. You can find this week's Dollars and Cents segment and others by visiting BroganFinancial.com.